Thank you very much, Joel. It's a pleasure to be here. Joel was kind enough to invite me last year. I was unfortunately somewhere else, but I'm very, very pleased that I'm here to participate in this very impressive conference here in Quebec City. I asked my organization, we have nearly 1,000 members from currently 96 countries, and when we're putting together the program for our annual seminar, last year in Rio de Janeiro, this coming year in Seoul, Korea, we poll our members to determine what are the topics that are of greatest interest to them. And every year, reinsurance is number 1, 2, or 3 every year. And I'm quite sure that it's a subject of equally great interest to the delegates here at the NICC. This panel will be discussing a $200 billion annual premium marketplace, a market of nearly 200 participants globally, but a concentrated one in which 80% of the total business comes from North America and Europe, although I suspect we'll hear that that's changing. A market where the top 10 competitors account for over 70% of the premiums, and also a sector that's seen a marked increase in the volume and frequency of large losses from both natural catastrophes, man-made catastrophes, increased insurance penetration, etc. So we're very fortunate in this respect to have 3 experts with complementary geographic and product experiences to present to us today and answer your questions. James Vickers, on my immediate left, is chairman of Willis Re International, based in London. Stéphane Palais is Chief Executive Officer of Caisse Centrale de Réassurance in Paris. And Brian Young is Chief Executive Officer of Odyssey Re in the US in Stamford, Connecticut. We have today timeless issues like where are we in the current pricing cycle. But we also have some timely issues like what are the lessons learned from last year's extraordinary cat losses. So let's get right to it. I'm going to sit next to James, take a chance and sit next to James, and start with our questions. I'd be grateful if each of you would comment on the state of the reinsurance market as we head into the 2013 renewal season. Anyone would like to go first?
I'll kick it off. I took over as CEO of Odyssey in April of 2011. Wasn't the best time to start heading up a company. 2011, as all of you know, was an extremely painful year for the reinsurance industry. A few months back, I think the total industry losses registered around $110 billion. It was the second costliest year for cat after 2005. And I think if you were to do the sums today, if you were to factor in loss creep in Japan and Thailand and New Zealand, quite possibly 2011 was the worst year on record. We suffered as a company, Odyssey, and the industry took significant losses. So it was a painful year. There are a lot of lessons that we learned from that, and happy to discuss those. We moved into 2012. It is quite amazing how fortunes have changed in a relatively short period of time. All of you who follow the industry will have seen reinsurers, global reinsurers results through 6 months. Most are coming in with combined ratios in the 85 to 90% range. It's been a light cat year, globally speaking, through 6 months. And that's reflected in reinsurers' results. So far, so good. I know there's been a significant loss in Canada in the third quarter, but in global terms, the third quarter, which is a heavy U.S. wind season, has been light. And so I'd anticipate results for the industry to mirror those through the first 6 months. So we head into 2013, assume nothing major happens between now and year end. You know, reinsurers will have had a very good year under their belts. And I think as we saw, I mean, we were all in Monte Carlo. I think the mood was very relaxed. I think reinsurers feel a little bit better about their circumstances today, have a little more cash in their wallet. And there doesn't seem to be any diminished appetite, for the business. So in broad terms, I don't think that bodes well. I mean, if looking at it from a reinsurer perspective, buyer obviously has a different point of view, but from a reinsurance perspective, I think it will largely be a stable market, but I do think in certain areas you will see some downward pressure, particularly where prices have been trading at high levels. For example, U.S. property cat, I think, is an area where you probably will see some modest downward pressure because results have been very good and prices are at or near historic highs. It's tough to generalize too much about the business because our business has become increasingly segmented. It varies based on territory and class of business. I don't think that if you look at Japan, for instance, you're going to see any softening of terms. You may actually see a little bit of hardening, and this is after successive significant rate increases the last 2 years. I think similarly in Australia, prices will remain firm, and not to be too bold, but or provocative. But I think a market like Canada, where there has been some frequency of attritional cat activity that's eroded the bottom end of programs, and the need and the demand for more BC quake capacity is going to keep pricing, honest. And if anything, maybe a little bit of upward pressure on pricing. But it is a mixed bag. It really depends, what part of the world that you're talking about, what class of business, have there been losses or not? Are there exposure issues that need to be addressed? So.
Stefan?
Yes, thank you. It's quite interesting because I could have started my intervention exactly on the same lines as my neighbor, because I took also my new functions as CEO of CCR exactly in April 2011. So I could have
same time.
Exactly made the same comment about how this year has been special, and I used to say that those years either you die, either you survive, and you're well trained. So obviously, I was well trained by this year 2011, and now just to turn to where we are now. I think I could also certainly share some of the comments that have been made, but I would maybe put a little nuance to what my friend has been said, and it reminds me of this story. When someone is asked, "How is your business?" and in one word, and he said, "Good." And then the person asks, and in 2 words, and say, "Well, not good." So I think we're a little bit in that situation, because yes, on one hand, after a year in 2011 that has been really a annus horribilis, a lot of people have been said. Yes, we reinsurance have been very resilient. We have proven to be strong enough to bear the shock of those events of 2011, and to be there in the market, to have the capacity, and to be there to serve our clients in quite good shape. But so this is the good part, definitely. I think the less good part is something that I actually felt in Monte Carlo, even though it was relaxed and with nice weather, and we all enjoyed being together and discuss the market. But there was a kind of undermining sentiment about something which is quite difficult to describe, because we don't know how it's going to evolve and unfold, which is the consequence of the low interest environment to our business. And of course, reinsurance have been very good asset managers. They've been very conservative, therefore they've been very resilient during the financial crisis, but it also makes them quite vulnerable to that type of environment. And as we were in Monte Carlo, I remember there was this very interesting panel with Denis Kessler and the chairman of Lloyd's, Sir Richard Ward, and others. The debate was, well, how long do you think this low interest rate environment is going to last? Do you think it's 5 years, 7 years, more? So when you project this to our business, frankly, it's something that is a little bit frightening. Of course, nobody knows how long it's going to happen. And the real consequence is not that we're going to become crazy about our asset management, but that we have to be very serious about our technical rates. So I know that in low growth economy, it's not always easy to make its client understand why you have to be, why you have to stick to a certain level of technical rates or even increase them. But I think the interest of the whole sector, the whole economy of the sector, is to have strong reinsurance that will be able to forbear this environment through their management of their technical rates. And therefore, I think it's a very important thing that we all have to bear in mind. Thank you.
James, would you share perhaps the broker's perspective with us?
Well, first of all, in the interest of equality, I will admit that I've been doing my job for a lot longer than a couple of years. I think I would agree completely. The global reinsurance market is in what I would describe as rude health. I think that the difficult 2011 result has actually given the industry as a whole a considerable degree of confidence. Yes, there were extensive losses, but the industry is coping with it, managing very well. Nobody's gone bankrupt. All primary insurance companies are getting their claims settled, albeit some of them are going to take quite a long time to settle. And that's, I think, we should remember in the wider global financial circles that we sometimes move in. That's something as an industry, I think, that the global reinsurance industry should be definitely proud of. And I feel that we don't articulate that enough. Having said that, it's clear that on a gap accounted basis, capital is abundant in the reinsurance market. There is this dilemma that mark-to-market accounting of assets is boosting investment returns and showing higher capital bases that may not be there really in reality. But that's what we're sitting at. Brian made a point about some of the loss-hit markets where prices have moved fairly significantly. But there's another problem that's coming, which reinsurers are beginning to have to listen to their primary clients a lot more, and that's sheer affordability. It's all very well saying we've had huge losses in Australia and Japan, but how much of a premium hike can the original policyholders take? And we are seeing clients in Australia who have put their rates up significantly. And when I mean significantly, we're talking in hundreds of %. And they are seeing clients opting for lower cover, bigger deductibles, because they can't afford it. So those primary companies are pushing hard. There's a direct correlation between the cost of reinsurance and the product that they're selling. And I think that unlike maybe a year ago, the market is having to recognize that. I would agree completely with the comment that the global reinsurance market is fragmented into many, many other different local cycles, which ultimately is good news because it's a recognition of a far more technical approach to underwriting and pricing of risk. The low interest rate environment, that's clear, is a worry. But again, I'd bifurcate that between the life and the non-life industry. Definitely life companies, the low interest rate, and as a knock-on effect, life reinsurance is a very, very major problem. But we just step back into the world of non-life business, particularly short tail, it's not actually much of a problem, provided the primary policies are issued on an annual basis and they can be repriced around that. So yes, reinsurers are making noises about the low interest rate environment, but the reality is we've recently completed a 1st of October renewal of a major European CAT program well in excess of €1 billion of limit. It's flat risk adjusted. You could argue whether that's sort of -1 or 0. It was barely placed last year. This year it's substantially overplaced and there's a signing down problem. I think that gives us a good run up to what we might see at the 1st of January.
I mean, just to follow on from what both Stefan and James have said, about low interest rates, as an industry, we have historically relied on investment income to drive return on capital, bottom line earnings. That's no longer there. I mean, we as underwriters, both on the insurance and the reinsurance side, we have to be called on more than ever to contribute to the bottom line. And it's challenging. It's challenging in Canada. It's challenging everywhere. You can load up on only so much CAT business. Your balance sheet only takes so much. But you really do need to find the margin. If you assume everyone, a pretty standard return on capital metric would be 15% after tax, which a lot of people are trying to achieve. In a 25% interest rate environment, that would be a 20% bogey pre-tax. Where interest rates are today, and given the relatively low leverage premium to writings, you have to run to between an 80 and an 85% combined ratio across your business, across all lines of business, to achieve that 15% return. That's a major hurdle, and I don't see that today. I mean, maybe your return hurdle is a long-term. You look at it over a long-term horizon, but certainly now and in the future, as we look out with the expectation that rates aren't going to move, it's a real challenge for the industry. I do think it will provide a bit of a prop and support for rate levels. But again, do come back. I mean, we are a supply and demand business. There is no shortage of capacity for most lines of business, and as long as capacity is plentiful, it's always going to have it's always going to put stable or downward pressure on pricing.
That makes me wonder about the prospect for increased primary company consolidation as companies stretch to achieve returns that are acceptable to their capital providers. What does consolidation in the primary market do to the reinsurance industry?
Well, I think that's a major challenge. It was interesting, Brian's point, saying that the reinsurance industry needs to run at 85 combined. There are very, very few major primary companies that could dream of running at that sort of margin. It's very clear that in an increasingly regulated environment, where particularly in the mature Western markets, growth is incredibly difficult, that consolidation is going to happen. We're seeing more and more in markets around the world that the major global insurers are taking shares within that. The difficulty is that the major global reinsurers are looking at reinsurance in a completely different way. Increasingly they're moving towards centralized reinsurance models because they understand that as they diversify their portfolios, they want to capture the value of that diversification and to leverage their group balance sheets as opposed to their local subsidiary companies. The net effect of that is that simple, low-level reinsurance business is being squeezed out of the market. It's being retained centrally in some form or other of a vehicle. And all the companies are looking to do is to push out into the global reinsurance market the areas of volatility and severity. So that's a big, big challenge for the global reinsurance industry because these people are buying in a different way, which creates a challenge about making sure that you have both the underwriting skill, the capacity and the product range to appeal to them, as well as the ability to manage a different type of relationship, because you're, by and large, the buyer is in the center. But ultimately, the total premium volume that's ceded is reducing. And as a consequence to that, certainly in the major reinsurers, we are seeing this push into other lines of business, be it life reinsurance, be it direct insurance, anything to access risk. Because this is the problem for the major reinsurers. They've got more than enough highly volatile risk, but they don't have enough stable risk. And so this move, white labeling of insurance product by some carriers, you see a lot of the major reinsurers have primary insurance paper as well as reinsurance paper. This is a trend that's going to continue and inevitably is going to produce some friction with their primary insurance clients. We see it now and again in market by market. And my personal view is that that is going to be the big challenge for the next 10 years for the major reinsurers anyway, who are following this strategy of how on earth they can grow their inverted commas primary business without upsetting their core reinsurance clients.
Maybe to add one or 2 points to that, because one can certainly not deny the challenge that was described that consolidation creates for insurers. But I tend to think there are maybe two elements that should be taken into consideration. One is the fact that this consolidation, of course, is happening amongst some very big players. However, it's always happening, I think, in fact, slower than we actually are expecting it. So it's something that is I think, spreading over time, and therefore it's not something that is a brutal shock, I think, to the sector as I see it today. Second, another point is that we in Europe are going to have one day or another, we don't know exactly when, but we are going to have Solvency II in place. In a way, a lot of things that are in Solvency II are already in place, in fact. And this definitely creates new pressure on insurance companies, new opportunities also, I think, for insurance to serve those needs. So there is here some maybe new needs that will have to be addressed during this process of consolidation that again is happening, but I think at a slower pace than in fact one could have expected already some years ago. Third, I tend to think that a reinsurer is also here to address new needs, new markets. And I think we are in a world where the question of new risk, new risk to coverage, a new solution for your clients is really something that is on our table every day. So yes, it's true, growth in terms of premium is not something that you see mechanically happening in our world. But on the other hand, the emergence of new risk and new needs and need for innovation is something that is really, I think, at stake for all of us.
I mean, certainly we as a market, both insurers and reinsurers have to be relevant to our clients and provide solutions that make sense. Consolidation is a really big issue. I mean, echoing James's comments, and it comes in many forms. Companies buying other companies. We've seen it, the bigger European carriers buying up companies throughout Central and Eastern Europe, and moving further east. It's taken a lot of reinsurance, individual country placements out of the market as those companies get consolidated into their larger groups. And as James said, companies are making use of internal pooling and cession arrangements to retain more. They're buying coverage on more of a multi-regional or a global scale, so fewer capacity, and then the aggregate, fewer placements and less capacity is needed to get the job done. Nowhere is consolidation more evident than in the U.S., particularly on the casualty side. The casualty reinsurance pie has shrunk dramatically in the last 5 years. I don't have any statistics to hand, but if I look at our own portfolio as a proxy, I would say it's down 60 to 70%. And I think from a broker perspective, and the brokers would certainly point to the amount of brokerage, the amount of activity coming from the casualty sector is drastically diminished. It's our job as reinsurers to find a way to become relevant. Again, I don't have any quick answers to that. Given where rates are and in the low interest rate environment, you can't really rely on investment income to bolster the bottom line. So it certainly is. It is a big challenge for the market.
I want to raise one more issue from the stage here before offering the delegates a chance to ask their questions from the floor for each of you to comment on, and that is, I'd like you to speak about the impact of increased regulation on both the reinsurance and the insurance market.
Well, maybe one word about increased regulation in Europe, because maybe I'm the one that sort of naturally placed to talk about it. As you all know, we have this debate about Solvency II that is moving in a sense that we are always on the edge of having Solvency II implemented, and I think one of the reasons that it did not happen already is not again because the sector is not ready. It's because there is clearly a debate about the level of the regulation that you would have through this. And as I think everybody agrees that the principle of Solvency II, which is capital at risk regulation based, is a very good principle, and this is something that in fact all the sophisticated companies I think do already master quite well. There is a debate about the level of the regulation that Solvency II will actually go to. And one of the reasons that we did not go forward is that clearly the level of regulation, of precise regulation, was completely inconsistent with the financial environment, because it was conceived at another time with a very precise degree of rigidity in a way. So I think this shows again why regulation is good. I think it's good for the sector. It's certainly part of the reason why the sector is resilient, is strong, and is able to manage its capital. But when regulation goes very much far away from the principles to go into a great level of details, including details that were forged under very different economic circumstances, you can get into trouble. And I think we are pondering today in Europe how to overcome this, to have regulation because it's good for the sector, but again, not to have the impediments of it.
Regulation, it takes many forms, and I dare say that on many levels, it's not a net positive, for the business. One form of regulation is restriction of access. And from a reinsurance perspective, you look at a market like Australia, a market like Brazil, a market like Argentina, and even Canada. In order to transact business in these markets, you have to have a local presence. Absent that, you need to put up collateral. That is restricting, global players' access to the business. That's not a positive from my perspective. The demands of Solvency II is imposing greater capital requirements, on our business. when we already have an abundance of capital. You know, you're expanding the denominator. You're making it much more difficult for us to achieve an appropriate return. We're going to struggle to attract investors as a result. That's not healthy for the business. And beyond the regulators, we have rating agency constraints on capital as well. That keeps way too much capital, in my view, in our business than is required. Other forms of regulation, we've seen in various parts of the world, and partly Solvency II, but local regulatory requirements, increased focus on corporate governance, which is a good thing, but the question is how far do you go with it? More rules-based regulatory intervention that, in the case of Odyssey, has required, if I take and look at our London operation as example, we've added headcount. We've added 20% to our headcount with no growth, in business. We've added expense to the bottom line, and that's largely to deal with the regulatory demands, Solvency II, the FSA, and Lloyd's. So it means more actuaries, more modelers, more compliance people, and again, to a point, I think there's value in that, but it's added greatly to the expense burden. Well, we're not generating the business or the profit to pay for it. I mean, one of our guys said, he kind of thinks we're running a compliance business today. That's what we're in the business of, compliance, and not underwriting. And I wonder if maybe we have that a little bit backwards. The other form of regulation, and again, I'm sorry to come back and focus on the U.S., but you're seeing the impact of regulation in two areas I'll name. One is President Obama's health care, what everyone coins Obamacare. That's having a major impact on the medical malpractice industry, insurance industry. You're seeing massive consolidation, smaller doctors, individual doctors being bought up by larger doctor groups being bought by hospitals. It's taking a tremendous amount of business out of the medical malinsurance industry, and so that change has had a direct negative impact on that marketplace. Another area where, again, regulation is having a big impact is crop insurance, in the U.S. And as all governments, and particularly the U.S., wrestles with what they can afford to spend, the federal government has been a big subsidy provider to the crop insurance industry. Those subsidies are going away. And it's having a big impact. On balance, if that's positive or negative, it remains to be seen, but certainly government action is having a significant impact on the way we operate in that particular sector.
James, final thoughts on regulation?
Yeah, I think two previous panelists have summed it up. There's both the good and the bad side of regulation. My sense is so far that we've seen too much of the bad, the increased cost. People think they're running a compliance department. We're an industry that's not been badly run. Certainly we compare ourselves to other sectors of the global financial industry. A lot of people are wondering why. What are we doing this? Now, maybe because I'm a broker and I'm always an optimist, I am beginning to see that the process of this regulation is actually forcing boards of companies to think about their business and think about their risk in a different way. And that in itself is producing interesting new ways of hedging and managing that risk. And for those reinsurers and advisors who can work in that space, who can help people find and look at their risk in a different way and find more appropriate ways in the new environment to manage it, I think the future is looking reasonably good. The problem is that the level of complexity and the level of technical underwriting skill across all classes and the level of organizational flexibility that reinsurers need to be able to pull the solutions together is going to test a lot of people. And it will be challenging to see how that works out. But we are certainly encouraged that at last companies are getting completely bored of spending tens of millions of dollars on complying with Solvency II, and the boards of directors are saying, well, come on, we've got to get some value out of all of this some way or another. So hopefully that will be a brighter spot in the years ahead.
Thank you all. At this time, I'd love to entertain questions from the floor. I think we have microphones available. And it's difficult for me to see out there. So. Do we have a question? Thank you.
Given the international flavour of the panel, I just wondered what your thoughts were on the Ryder Cup victory. No, just joking. I mean, a lot of the comment has been about the mature markets of North America and Europe. And I just wondered, you know, James's comments about reinsurers getting involved in primary insurance, and Brian kind of saying that it's important to find ways for reinsurers to be important again. Do they see a kind of an alliance with the emerging markets of the Far East or South America or India? Do they see a future there for the reinsurance industry to become resurgent?
Well, obviously emerging markets look extremely attractive. If you look at it from sort of 10,000 feet, it looks absolutely marvellous. I mean, the premium incomes are booming. You know, people are saying, gosh, you know, you look at something like the Chinese automobile market in the last 5 years, the growth is absolutely stunning. The problem is, step down from 10,000 feet and get down to ground level, and how do you actually, A, access that business, and B, try to make a profit out of doing it? Because sadly, in a lot of the emerging markets, the base product, the insurance product, is sold on one thing and one thing only, and that's price. The distribution systems are, shall we say, not good at adding value. So it's a pretty ruthless game to play. And I guess the Thai flood losses is a classic example of, you know, how badly wrong you can get it. You know, those reinsurers who wrote pro rata treaties in Thailand without event limits, you know, have been absolutely crushed. And who thought that such a thing could happen in a market like Thailand? So yes, it's a very exciting and interesting market. Yes, everybody wants to get involved in it, but you have to be very careful. And you have to employ people and have access to local knowledge and understanding of how these things are going to work. At the same time, in the emerging markets, the major global reinsurers don't have it all their own way, because the local capital providers, they've worked out this reinsurance game looks quite good fun. And there are a surprising number of local and regional reinsurers. And two of them in particular are pretty powerful. Two of them have broken into the ranks of the top 10 global reinsurers. They've just done that. That's Korean Re and China Re. Well, a lot of people might have thought China Re, inevitably they were going to get there. Crick, there's an interesting. So it's not a bed of roses, I'm afraid, but it's an opportunity that we all have to look at.
To echo, I think China is a huge opportunity for our industry and for the market. It's one of the few places around the world where you are seeing significant growth. I mean, the insurance market in China is growing at 15%, 20% annual rate. The market today is $70, $80 billion. It's you know, it's third after the U.S. in Japan, and the growth potential is enormous. Results in the early days were pretty poor in China. You had the snowstorms in 2008. A lot of losses, multiple events hitting programs. People didn't really understand their exposures very well. But since then, you have seen positive change. It's a more professional approach to the business, a more technical approach to the business. It's not perfect. It needs to continue to evolve and improve. But you know, from an Odyssey perspective, you know, we view, you know, China, maybe not in the next few years, but certainly down the road, as a real growth market, and we want to participate in that growth, and we're investing in resources to be positioned to do that effectively. Brazil is another market that is a growing market. Brazil is challenged now by capacity. It's extremely competitive marketplace. It's not perceived to have a nat cat exposure, although their flood risk is evident. And after Thailand, I think more of both the Brazilian insurance market and reinsurance market is starting to focus on the flood risk exposure in Brazil. Aside from that, India's got enormous potential for growth, but still is probably lagging, certainly lagging behind China in terms of development. It's also an industry that suffers from perhaps more intense competition from the state companies that tend to dominate that market. I mean, as a reinsurer, we don't really see the margin opportunity in India that we see in other parts of the world, but you can't lose sight of that given the size of the market and the potential for it to grow over the course of time. One thing that James touched on in Thailand about lack of event limits, I'd say that was one of the big lessons, and why we had to learn that lesson. We should have known that, but it's clearly, not having event limits and having this runaway cat exposure with programs generating loss ratios in the 3,000% and 4,000%, you're never going to get paid back, from that, and that could do serious harm to your reputation and your balance sheet. And so there is an effort. Not that there are that many parts of the world that operate on the reinsurance without occurrence caps, but there's a few, and they've certainly come into focus in the reinsurance community. There are territories that have occurrence caps. Those occurrence caps, though, tend to be pitched at multiples 4 to 5 times, what the perceived PML exposure is. So is that a capped exposure or not if it's 4 or 5 times above the PML? And we as an industry are trying to wrestle and trying to come to grips and try to contain our exposure. Another lesson that I think it's worth mentioning that came out, particularly out of Thailand, is, as many of you know, the Japanese market was hit particularly hard by Thailand, some of that coming through their local Thai companies, but a lot of it going back into Japan, into their main global treaties. And so we have this term interest abroad that has been included in so many reinsurance programs, both risk and cat, around the world. And the reinsurance market really didn't focus that much attention on it because it was perceived to be fairly innocuous, maybe would represent a risk exposure, but not a cat exposure. And the Thai floods really shone a spotlight on how wrong you can be in that respect. And so I think as a market, and something maybe perhaps to bear in mind if you're looking to buy broader territorial scope cover, I do think the reinsurance market, if you want to have it covered, we'll consider it. But we need to work together. We need to do a better job of identifying the exposures and getting a handle on it, trying to model it as best we can so we understand, what we're assuming, and we can price for it.
I want to continue to talk about Thailand, but and you've mentioned most of it, but I think Thailand is really, you could actually use it as a business case that in fact would be very useful for people to learn to go to any emerging market, I think. I think most of the issues you mentioned are exactly right and very important. So there was also, I think, two things in addition that one is something that nobody imagined before, is that as a consequence of Fukushima, in fact, people moved some industrial capacity to their Thai plants. So in fact, the risk of Thailand was increased by another event in 2011. And nobody, of course, has ever imagined something like that. But I think something that was much more, I think, possible to imagine and to take into account and would have made people think that they were underpricing the risk is the fact that Thailand has just completely changed and very rapidly in very few years. When you have a country that is growing 7% or 10% per year, which is something that we don't know in our own market, this country is changing completely each year. So the fact that you don't look forward to the way the country is moving on and the consequence of the risk, and rather you continue to price it as it was an emerging country, quote unquote, which means not a lot of value, is clearly putting you in a very dangerous situation. So I think this is a lesson that can be probably applied to many emerging markets where the risk is changing every year. So you have to ask the question of the prices every year instead of just, renewing at the same rate as a lot of people have been doing. Sorry.
Another question from the audience, please. I wanted to ask before we ran out of time, especially from the buyer standpoint, what does the influx of capital from pension funds and hedge funds and other non-traditional providers of capital to the reinsurance business, what does that mean for the buyers and the providers and the intermediaries in the reinsurance world?
Okay, well I suppose I should have a go at this first. Certainly buyers of major peak zone catastrophe risk, this influx of capital is good news. And it's not just good news for the buyers, it's actually good news for the reinsurers because most reinsurers have got enough peak zone cat. So in that sense, that spreading out is very helpful. It's the impact of the capital where else does it go? Well, it goes a lot into the retro market. There, again, tends to provide peak zone cat capacity, but then is also providing some more sideways capacity as well. What we have not yet seen, and we're all watching very closely to see whether this will happen, is when will this influx of capital drop down to provide true quota share, follow the fortune indemnity cover. Most of the capital coming in is getting closer to doing that, but it hasn't stepped yet completely into the space of essentially providing the traditional reinsurance product. I think the other thing that certainly a lot of observers are looking at very closely is the source of this new capital. Obviously, historically, quite a lot of it comes from hedge funds, and by their nature, hedge funds may not take a terribly long-term view. Of far greater interest is pension fund money, where they have a different horizon, a different concept, and I think probably slightly lower investment returns. Now that movement is interesting. We are watching very closely where it's going at the moment. Inevitably, most of the money is going to the well-proven managers who have a strong track record, and some of them are building up really very, very substantial sums of money under management. And the question is, how will they deploy that capital? So at the moment, it's all very welcome, certainly in the peak zones and in the retrocession market, but I don't yet feel that they're really able to challenge and use up the traditional market.
I would agree wholeheartedly with that. I think that, first look at the ILS market. What is it today? About $6 billion. There are individual cat programs around the world, single programs that are bigger than that. So I don't think, and the ILS market's been around, it's been talked up for quite some time, and still hasn't grown. It's still fairly narrowly focused in peak zone cat. So, it does serve a purpose at the margins, but it's not something that, I see as a threat to the traditional reinsurance model. The new alternative forms of capital coming in, particularly the hedge fund formations, they're all fairly small. The capital that they're putting in place is $500 million. I always thought that the point of entry in the global reinsurance market used to be $1 billion. It's moved up to 3. Some would say 5. So I'm not sure with 500 million, what you hope to achieve. But I wouldn't expect, again, in a market that's awash with capacity, that they would have much of an impact. I do think that this form of capacity that's coming in, maybe that is the future. Call them sidecars or hedge fund sponsored reinsurers, fluid forms of capital that come in and take advantage of market conditions and then move back out. It's conceivable that that's what we see going forward, instead of having a class of 93 in 2001 and 2005. When the next hard market comes, probably much more likely that we'll see sidecar type formations, as we've seen.
Okay. Just one related issue. We talked about the extraordinary catastrophe losses of 2011, and it reminded me of some of the shortcomings that we've seen from CAT modeling. And we need CAT models, and we need them to work better. What can we do about this?
We should remember CAT modeling is a very new science. There wasn't any CAT modeling before 1992. To say CAT modeling is in the adolescence as an industry would probably be kind. There is so much more that we need to do, and I think the rude shock for the industry is that we cannot rely on the CAT models. I think some people have allowed the CAT models to become their masters as opposed to their servants, and certainly 2011 has driven that message home. So I think people take a much more mature view about CAT models, and they're having to form their own view of risk. This is one of the things that's also coming out of the regulatory pressure. The days of somebody being able to go to a regulator, let alone a rating agency or their stockholders, saying, I've done everything on my RMS model, it's all absolutely marvelous, optimized my portfolio, that's not going to work anymore. The challenge is ultimately we're going back to underwriting decision making. Yes, the models and multiple models, more and more people are using more of them, will produce all their answers, but essentially companies will have to take all that information and make their own mind up on what it means for them and their portfolio. So this concept of own view of risk is what's coming. You haven't seen it, there's a very interesting paper that's being put out by the ABI in the UK, the Association of British Insurers, and it's essentially supported by the UK FSA, because a lot of big insurers started going to the FSA because under Solvency II you have to produce your 1 in 200 figure. And people say, well, could you explain, what are you expecting to see? And this prompted a working group that was put together to produce this document, which is essentially the first document on best practice CAT modeling. And it's interesting, it's a very interesting document. You can download it from the ABI. I recommend any of you who are interested in it, read it. But it does talk about use of multi-models and companies making and documenting their own decision around it.
Stefan, how do you feel from the user standpoint?
Well, I was going to say that when I came last year into Monte Carlo for the first time, the big event was, of course, the version 11 of RMS. And I was, frankly, quite shocked as a newcomer to see the whole sector being so dependent on an announcement, on a model, which, frankly, it was hard to believe for me that it was the truth. So this was one of my sort of important experience. And of course, the other experience was that, not to go back to Thailand, but of course, Thailand was not modeled anywhere. So after that, after those two facts, you become quite pragmatic about models. So it's like a lot of things. Probably it's very important to think about it, to work on it, to have your own model. but please don't become addict to models. And I think it would be an incredible risk for this industry to become addict to models. And it would be, I think, also a way for this industry to sort of rely on others for what its core business. So really, in my view, master your own modeling is key if you want to be a real reinsurer.
Absolutely. Absolutely. 2011 was the year of the unmodeled loss or undermodeled loss. Slave Lake wasn't modeled. Thailand wasn't modeled. The tsunami content of Japan, wasn't modeled. New Zealand had three earthquakes, trashing programs completely in an area that wasn't deemed to be the peak territory. There are other events, Cat 46 and Cat 48 produced losses much bigger than what the model would have anticipated in the U.S. So with losses, comes the opportunity to recalibrate, the models, and hopefully, we'll see some improvements there, and they'll have more credibility as you move forward. You need losses in order to test the model. And I know in Canada everyone's focused on BC. Well, the model's untested. It remains to be seen what will come out of that. But as we've seen around the world, the model's always going to be wrong. The question is it going to be wrong high or is it going to be wrong low? And more often than not, it's come out on the low side. So I as an individual, and hearing my panelists here, co-panelists say as well, I wouldn't put all the blame on the models, because at the end of the day, if Thailand isn't modeled, well, that's not the modeling vendor's fault. And if the tsunami content of the Japanese earthquake wasn't modeled, well, we knew tsunami wasn't included. That's not the modeling. It's not the vendor's fault. So, we as underwriters just need to be more diligent in making sure that we understand completely the exposures, and we're factoring them in. I mean, and Canada is a prime example of this. There has been some loss activity, albeit at the bottom of programs, but a lot of it's been unmodeled. If your starting point is just to take the model output and load from that, well, what about the unmodeled loss exposure? And I'm not suggesting that there should be a big increase in pricing as a result of that, but there's got to be some recognition of the unmodeled element of loss. And the last thing that I think is relevant to the whole modeling discussion, the model is only as good as the data that you put into it. If you're putting garbage into the model, then the output is certainly not something that you can rely on. So I think data quality is improving in most places around the world, but it needs to continue to improve. For us to really have, for both the buyer and the seller to have a much better understanding and awareness of our exposures.
Every discussion of reinsurance that I've been involved in, either as a participant or as an observer, has a run out of time before it's run out of important questions, and we've done that today once again. So I want to thank Brian, Stefan, and James for a stimulating discussion, and invite you to seek them out to ask their thoughts after